Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our June monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So a few announcements before we begin. I want to congratulate Valerie Roque for 8 years serving our amazing clients, and also for Eddie for 4 years of serving our amazing clients. And lastly, Nick Dominguez for 2 years serving our amazing clients. We hope to see many of you in just a few weeks at our quarterly investment forum on Wednesday over lunch, July 16th, 2025. Should have already received an invitation, but if you need one, please let us know. This is not a t-shirt that we're wearing currently. This would not indicate all of the things that's going on right now. We'll try to summarize a few of them without being too long today. So we'll start with just where the markets are. So as of end of last week, the S&P closed at just under 6,000. But with a lot of volatility this year, at its low point from peak to trough, markets declined almost to a bear market, down 19%. Year to date, markets are basically flat. After a really difficult April, we had one of the best Mays since 1950, with the S&P up just over 6%. And as everybody's been following the last 10 days or so, Middle East conflict is now an enhanced geopolitical risk with June 13th, Operation Rising Lion, and then over the weekend, Operation Midnight Hammer. We'll talk just a little bit about what we know. We won't add to the news information that everybody's consuming, but just kind of talk about how the market is at this point. And we'll see this since June 13th, the S&P is slightly lower, and on Monday, June 23rd, markets are actually up. So it's obviously an elevated level of risk that could impact markets. But again, at this point, since June 13th, since Operation Rising Lion started, about 1 to 2% off. And the S&P is about 3% from all-time highs hit in February of this year. So at this point, markets are, again, they've already priced in this risk, or they're kind of in a wait and see mode. So far, not a lot of market volatility in spite of a lot of news regarding these two recent events. And those events have somewhat kind of taken the attention off of the elephant in the room, which was tariffs from early April. And this is kind of what we know about tariffs at this point, which is the result's going to be positive, negative, or somewhere in between, but that the uncertainty of tariffs, certainly in early April, led to a lot of volatility. And one of the other things we don't know is what the markets have priced in at this point. So after the initial announcements in April, on April 2nd, markets went down dramatically. And does that reflect markets pricing in the most negative outcome, such that somewhere in between positive, negative is supportive? We just don't know. And this is something that's worth considering, that if markets priced in something close to 25 as an average tariff rate, and you get 15, again, that's an example of where the outcome of tariffs could be supportive of risk assets. But what we do know is this uncertainty led to a lot of volatility in early April. April 2nd to 4th, markets were down about 10%. And when there was a 90-day pause announced on April 9th, which, by the way, is coming up in just a few weeks, the 90th day from April 9th, markets were up 10%. So a lot of volatility in April. This is a significant time frame to be thinking about as we approach July 9th. But again, a lot of volatility in early April. But what's interesting is if kind of you took a long nap from end of March until now, you'd wonder what was going on, because markets have basically recovered this decline. As it relates to inflation, a pretty good read in May. 2.4% on CPI and 2.8 on core, which excludes food and energy. So a pretty good recent inflation read, which is connected to what the Fed's going to do or not do. This just kind of follows the path of the last few years of 11 increases to interest rates, three at the end of 2024 rate cuts. And we've been in pause mode since December, and we stayed in pause mode this past week where the Fed did nothing, kept rates exactly as they are. But what's interesting, one of the Fed governors, right after the Fed decision last week, went on CNBC and said that they thought, this Fed governor thought that rates should be cut sooner than later, saying he saw the rationale for a cut as early as next month. So again, worth keeping in mind, as it relates to financial market assets that likely want a Fed rate cut sooner than later. This is the most recent read on GDP. We saw a negative Q1 GDP. But what's interesting is the Fed Reserve Bank of Atlanta has made some news in recent days, predicting as of June 18th, this is updated daily, expectation that Q2 GDP will be 3.4. So that would be very supportive and a very good number after a contraction number in Q1 of this year. The jobs report was pretty good, 139,000 jobs added, unemployment rate of 4.2 and wage growth of 3.8. So overall, a pretty good jobs report in May. So that's connected to how our consumers feeling. And this past Friday, we saw a sentiment index from University of Michigan at 60.5, and this is dramatically up from the prior reading at 52.2, and it's the first time there have been any improvement in 6 months. So overall, consumers are feeling pretty good as it relates to sentiment. And that connects to kind of the way we're following both soft and hard data. Soft data is kind of a measure of how people feel, and then hard data is an actual measure in the rear view mirror of what things actually did. So soft data is an example of consumer sentiment that we just spoke about. The most recent reading was 57, now 60. Employment, inflation expectations, consumer confidence are more how people are feeling. And the question is, depending on how these are trending, does that carry over into hard data, such as GDP, unemployment rate, payroll, inflation, things of that nature? So debt and deficits remain a key issue. We're running about a $2 trillion deficit, 4.9 trillion of spend or of tax receipts against 6.7 of spend. Interest rate or interest expense on the debt, just to service the debt, is over $1 trillion. So this remains an issue. And in fact, Moody's just recently downgraded the U.S. debt. What's interesting about that downgrade is you would expect bonds to sell off on this news. But since that downgrade of debt, the 10-year has gone from 4.58 to 4.34, indicating buying of the 10-year over that period of time. So that doesn't mean that the 10-year is rallying because of the debt downgrade, but that there are other factors in play. And the downgrade at this point isn't having a big impact on the pricing of the 10-year. So as it relates to headwinds and tailwinds, some of this is the same and some of it is slightly changed. So potential tailwinds or things that are supportive of markets, tax cuts. So this is an issue that, as it relates to congressional extension of the tax cuts, which they have a target of July 4th to pass this. If it passed, that would be a tailwind. It would remove something that's not known at this point for 2026 and beyond. Less regulation and optimism. Headwinds, trade tensions. Again, we're at a 90-day mark from April 9th to see where tariff policy winds up being. Deficit concerns remain an issue. Labor tightening, and you can add enhanced geopolitical risk to this potential headwind in the market. And this is just zooming out, thinking about 100 years in the market and what have markets done over that period of time. 73 since 1926, 73 up years and 26 negative years. All of those negative years are painful and tough to go through. But it's important to note that 3 to 1 markets are up versus down, and the average positive year is up 21 versus the average negative is down 13. So none of this is a replacement of contacting us directly to discuss how these things apply to you. So please reach out to us, leave no question unanswered. We're here to serve you. We hope to see many of you in just a few weeks at our forum at Perry's. So please RSVP for that if you haven't already done so. And with that, we'll close. Again, we want to thank our clients for the trust and confidence that you place in us. Please reach out to us if we can serve you in any way. We hope to see many of you in just a few weeks at the forum. Until we see you again, be well and take care.